Hi, welcome back. It's Neale here, and we're going to look at part 2 of international taxation, which is we're covering in this course international accounting and taxation, but we want to expand. That's why I've got 2 parts, 2 videos. The part 1 basically introduced the landscape of taxation, how tax is assessed, whether it's on the source of income, whether it's on residency and different parts. It's basically the landscape of the basis for how different countries around the world tax our income. So in part 2, I'm so thrilled to go through some of the more intricate arrangements that countries have to make sure that they get their slice of the pie. They don't want their citizens shifting money offshore and losing the benefits of the earnings that some citizens make offshore, while taxing heavily those domestic earnings of other citizens that don't have a chance. Okay, so we're going to cover double taxation agreements. We're going to look at foreign income tax credits, both direct and indirect, and we're going to look briefly at tax treaties that exist, and then the translation of foreign branch income very briefly, and finally tax incentives. So let's have a look at the landscape, shall we? Double taxation and foreign tax income credits. Let's get into it, shall we? All right, so under double taxation, it's all about we want the same income is taxed by 2 countries, and so you know that it's not really fair that you pay tax in one country and then that income becomes taxable in another country. And so countries have come to agreement to say that, well, this is not a really fair thing, that you earn $100 but you end up paying $70, $75 or $80 in tax and you keep $20 for yourself. That's definitely not going to work. Okay, so what's really interesting is determining what are the vehicles by which the tax is being earned. So we're going to look at some issues associated with foreign branches, foreign branch income, and then we're going to look at issues with subsidiaries. So they are treated differently in the US in terms of their foreign income, and so we want to look at how double taxation works with that. Before we do so with those examples, what's really important to think about economically, that, and a lot of governments around the world are aware of this, is that ideally taxation should be in the background. It shouldn't be in the forefront as driving strategic tax planning of multinationals. But the fact remains is because countries are different, they don't have the same approach and the basis for determining and taxing individuals and their companies, then the scope for bringing tax factor in and the differences across the countries is very relevant and very important for strategic tax planning, and more importantly, very important for investment tax planning, that is where you locate your subsidiary. So let's go into some of the issues of how countries have agreed to avoid double taxation. So there are bilateral tax treaties as a mechanism for elimination, and there are foreign tax credits as a mechanism for elimination. Okay, so double taxation. Here's some of the solutions for double taxation. There's the adoption of a territorial approach. So for example, Hong Kong has adopted this. That is, you're a resident in Hong Kong, but if you earn money outside of Hong Kong, then you don't have to pay tax on those earnings outside of Hong Kong. You may have to pay tax on those earnings in the other country you earn it, but you don't have to pay it in Hong Kong. So that really simplifies a lot of things, because it means that you don't have to look for double taxation agreements between Hong Kong and other countries in determining credits you need to get in Hong Kong. You're not going to get a credit in Hong Kong because you don't have to pay tax to begin with, but it might have to go the other way around. So for example, if you have to pay tax in USA, then Hong Kong's tax treaty in the USA is going to be very important for you being able to, when you fill out your return in the USA, whether you actually get tax credit or whether you can avoid declaring that income in the US law. But we'll get to that in a minute. Deduction of taxes is another approach that governments around the world have taken. So they allow a parent company to deduct taxes paid by subsidiaries or paid by branches in other countries. That's under the direct foreign tax credit arrangement. Another solution is the deduction of taxes paid to foreign governments. Then we have tax credits. They're tax credits to the parent company and tax paid to foreign governments. Okay, so we're going to look at these different approaches that countries have made, but in some ways it's very US centric because this textbook is US centric in that way. And while we're talking about that, let's begin. US allows the deduction of taxes approach and a credit approach, so we can have a look at both of those approaches. So what do we mean by the calculation of a foreign tax credit? So what do we mean? Well, let's make sure what the acronym is. It's FTC. And there are two types of foreign tax credits. There are the direct credits, and so they basically apply to branches of US companies. Then there are indirect tax credits, and they're normally paid by foreign subsidiaries, taxes paid by foreign subsidiaries. And as you guessed it, normally that comes home the roost when a foreign subsidiary wants to pay a dividend back to the home country, US, home parent company in US. And so you're interested in getting that indirect foreign tax credit to help counteract any taxes paid on the before tax of that dividend. So the foreign tax credit generally is the lower of actual taxes paid to the foreign government, or taxes if the income is earned in the US. So US taxable corporate rate 35%. If you earn $100, you pay $35. If you paid 37% tax in another country, then your credit is only going to be $35. That's basically what this is saying. If you only paid $32 of tax, 32% in another country of $100, your credit is only $32. So that's what we mean by FTC is lower of taxes paid to the foreign government or taxes if the income is earned in the US. So the minimum FTC, that's the foreign tax credit, is the foreign source taxable income divided by worldwide taxable income multiplied by US taxes. Before, that's the overall limit, and the excess foreign tax credit can be carried back 1 year, that's if you don't have enough profits, or it can be carried forward 10 years. So that's an important thing, that you can actually carry it forward over time, because you may not have profits in every year. That forces you to pay tax that you want to get credit on in your home country, the USA. Okay, double taxation. Let's have a look at an example now. So we're talking about the foreign tax credit. Remember, we're talking about overseas branches of US parent companies. Overseas branches, not overseas subsidiaries. That's why we're in the direct foreign tax credit here. So assume GCO is a US company and has a branch in Mexico where the corporate income tax rate is 33%. So the US corporate tax rate is 35%. The foreign source income in Mexico is $50,000 and GCO pays $16,500 of corporate income tax. What does that mean? Well, that's basically 33% of $50,000, and that gives us our $16,500. GCO also pays $20,000 of other taxes. GCO decides to do a calculation, choose between using taxes paid in Mexico as a deduction or tax credit. Now remember, the reason why you have a choice of a deduction or tax credit, the deduction would tend to make sense, or one or the other would tend to make sense, especially if you have a lot of other taxes that make your total rate to be even greater than 35%, which is the US tax rate. Because under a tax credit, you can't get more than 35%. So let's have a look at how this example plays out. So under the deduction rule, this is in the US law, the foreign source income is $50,000 at both sides, but the deduction rule requires you to deduct all taxes paid in the foreign country, Mexico, $36,500, leaving you with $13,500. Let's draw that here. Over here, we're not changing anything here. The US tax before the tax credit is $4,725. Over here, the tax that's 35% of $50,000 is $17,500. With the foreign tax credit, you're only allowed to take out $16,500 of the $36,500 down here. You're only allowed to take out $16,500 because that is the income tax that you paid. Under the deduction approach, you can have the income tax plus other taxes paid. Under the foreign tax credit, you can only get credit for income tax paid. So what is really interesting here, the net tax liability under A, the deduction approach, under B, the credit approach, B is definitely much better because the net tax liability is only $1,000. And part of the reason is that you are actually getting a dollar for dollar credit at this level here, at this stage here. Okay, whereas under the deduction approach, you are not getting a dollar for credit for tax paid. It just reduces your foreign source income. Okay, and so there is still income remaining, and then there's 35% applied to that income. So there's one reason why we have the credit in many instances is a much better approach than the deduction approach. Let's have a look at this further, shall we? We have another example from the textbook, page 551. Again, this is a foreign branch of a US parent company. What does that mean? Under US tax law, foreign branches income is basically the US company's domestic income, and it's added up. That's why understanding how to get a credit, whether it's a deduction approach or a credit approach, is very, very important. So we have a foreign source income of $100,000 in both, but there were taxes paid by the foreign branch. Under the credit approach, there were income taxes paid of $30,000, and there are other taxes paid of $10,000, making $40,000 here. Okay, notice that under the credit approach again, under the credit approach, the net tax liability is only $5,000 compared to $21,000 here. So keep these things in mind. There are, in summary, under the direct foreign tax credits, there are two approaches. There's the deduction approach and then there's the credit approach. Under these two approaches, the credit approach tends to be much better in minimizing your US tax liability under those two examples. So let's have a look at foreign tax credit basket. So this is remember I mentioned earlier, when you have a foreign tax credit that is greater than what you could get a deduction for because your income was not very high, then you can choose to carry that forward by 10 years, or you can carry it back 1 year on your previous income earned. Okay, but there's a trick to this, because in 986, what they said was, yes, you can carry it forward 10 years, but you can only carry it forward in each of the 9 different baskets. They simplified that, of course, by 2004. Basically, there are 2 baskets, general income and passive income. So you can carry forward 10 years or back 1 year, anything to do with general income earned by your foreign overseas branch office. You can do the same with passive income, but you cannot mix and match the two. Okay, you cannot do that. Okay, you can only carry forward or backwards general income. You cannot offset against passive income, and you can carry that forward and backwards. So keep that in mind as we go through other rules and restrictions on how the US gives benefits or tax credits for the US companies that have operations overseas. So we talked about direct foreign tax credits, and that's for branches that operate overseas. And that's very important because a branch overseas is treated as a domestic entity in terms of US tax law. What about indirect foreign tax credits? This is for subsidiaries overseas. Now remember, what is the definition of a subsidiary under tax law? It's basically a separate entity. So therefore, whatever the subsidiary earns is not the earning of the domestic company in the USA. And this is very important to consider here. And it gets back to the Apple example, because Apple has subsidiaries all around the world. They're gathering these billions and billions of dollars of income and cash, billions of dollars. And in order to get that cash, these subsidiaries have to pay dividends to Apple in USA. But Apple is not getting them to pay dividends because Apple doesn't want to pay tax on those dividends. So this is the tricky part with subsidiaries. Just because you can earn money from subsidiaries in other countries and avoid US tax, at the end of the day, you have to pay US tax on any dividends paid by those subsidiaries to your home office in the US. We understand that there is an indirect foreign tax credit that is applied to these dividends that makes it more palatable to encourage subsidiaries to repatriate profits back home. And see, what does that mean? Okay, there is an adjustment to work out what is the before tax amount of that dividend, and then there's a credit given for that amount of tax paid in the US tax income calculation. So how do you qualify for indirect foreign tax credit? Number one, US company, of course, and the US company owns a minimum of 10% of voting stock of the overseas subsidiary. So basically, this is what indirect foreign tax credit is about, and it's about trying to give some offset for any dividends that you receive from subsidiaries overseas, and basically they are after tax dividends. In other words, tax has been paid by the subsidiaries, then they pay a dividend back to your home country, the US, and the indirect foreign tax credit kind of works to help offset that double taxation effect on those dividends. So we're getting on to tax treaties now, and this is very important. We're moving off from foreign tax credits. Now we're moving to tax treaties, which actually apply to the whole countries around the world, a lot of countries around the world, not just US and other countries, but it works for, say, Hong Kong and China, Hong Kong and Australia, Hong Kong and Singapore. So there's a lot of bilateral agreements around the world about how to tax individuals of one country when income is earned in another country. The reasons are to alleviate double taxation problems, to facilitate international trade and investment. There's extra information sharing between governments because of this, and it helps in domestic enforcement. So the OECD came up with a model treaty that is the basis for most bilateral treaties of developed countries. Basically, they came up with the idea that it's a tax if there's a permanent establishment in one country, and it recommends a reduction of withholding tax rates. And so the following withholding tax rates were agreed upon: 5% of direct investment dividends, 15% of portfolio dividends, 10% of interest, and 0% of royalties. So you can immediately, as soon as we're talking about dividends, we're really talking about subsidiaries. And so what we're really saying is that a subsidiary overseas, when it pays money back to the US parent, other countries have agreed through treaties to only, if they follow the OECD model treaty, they will only promise to actually withhold 5% of direct investment dividends or 15% of portfolio dividends. So 5% tax or a 15% tax. So it's a very low tax rate, like a tax haven type tax rate. So therefore, when it comes back in the US, you can imagine that most of those dividends will be actually taxable in the US. And so you can apply that to any other country that does tax at the full rate of dividends received from overseas. Keep that in mind. This is the model treaty. This does not mean that countries are using this, but this is what the OECD has set up as a guidelines for countries to follow. So what has Hong Kong done? They have comprehensive double taxation agreements with a lot of countries around the world, and this is just to alleviate all of these country investors who have operations in Hong Kong that pay Hong Kong tax, and they're able to actually get relief from their own country taxation agreement. So most of these agreements are to encourage a lot of investment to come through Hong Kong, to basically say that, okay, if Hong Kong taxes you for your earnings in Hong Kong, then you won't get taxed on those same earnings in the other country, or any of your Hong Kong subsidiaries pay dividends to another country, then you're not going to get taxed if you have actually paid tax on those dividends in Hong Kong. So these are different treaties that Hong Kong has signed with other countries. As you can see, this is an ongoing thing because there's dates for everything, even 2014, 2015 for Mexico. So there's a lot of complexity here in what Hong Kong has an agreement with one country may be different from another country. So it's very important for a multinational in their tax planning to really understand the intricacies of the treaty agreements between the home country and the foreign country. What about US tax treaties? Well, US has signed many tax treaties with countries, and some of the issues or the basic ideas of the tax treaties are there's a 0% withholding tax on interest and royalties. There's a 15% withholding tax on dividend payments. That is, if I have an investment in USA and I get interest and royalties, they won't take withholding tax from me. If I receive a dividend from the US, they can take up to 15%. So this is one model US tax treaty has. There are treaties with over 50 countries, with one notable exception, Brazil. That's because of lack of Brazilian investment in the US. But of course, companies are engaging in treaty shopping. What does that mean? They are finding ways or tactics to go indirectly to find benefits. So for example, at one stage, Brazilian companies were setting up a subsidiary in an island just off Brazil, which was French owned, that had a treaty with the US, and that enabled that to get dividends out of the US back into Brazil without having to pay withholding tax in the US. But the US has since banned that practice, and it's much more difficult now to do treaty shopping. But keep in mind, this is another part of the strategy of multinationals. What about foreign controlled corporations? This is very interesting. Let's first define what we mean by a foreign controlled corporation. Foreign controlled corporation is where a US company, they have a subsidiary overseas, they own at least 10% of the stock, but they have more than 50% of the voting power, depending on how they set up the articles of association. And so therefore they can actually control what that company is doing, about when it pays a dividend, when it doesn't pay a dividend, and other arrangement that that company might have. This is especially important, especially if that foreign controlled corporation is actually in a tax haven type country, where that country is not paying much tax, 15% or lower, for example. So to combat the practice of foreign controlled companies being used to harbor income by not paying dividends to the parent, Apple was doing something like that, right? The foreign controlled company law treats a foreign controlled income as if a dividend had been paid. That's very interesting. So I'm a US company, I have a subsidiary in another country, and maybe it's in Singapore, okay? So it's only paying 15% tax there. And I control it to say, okay, don't pay dividends to the US, you pay 35% tax on that. Even after the tax credit, you're paying 20% more. Just don't pay the dividend at all. But under this new law, that company may be deemed to be a foreign controlled if I have more than 10%, if I control that company more than 50%, and if that company is in a tax jurisdiction whose tax rate is less than 90% of the US tax rate, which is 31.5%. Singapore is in that. So therefore, the US tax law will deem my company to be a foreign controlled corporation, and any income that earns will be deemed as dividends paid back to my home country as the parent. Even though I make the decision for it not to pay a dividend, there will be a notional dividend deemed to have been paid by the US tax authorities. And so that's a tricky thing. That puts a huge complication in your international tax planning, because you've got to think of all these different factors that deem a foreign controlled corporation to be a foreign controlled corporation. So keep this in mind. This is a very important arm of the US taxation law. And so part of the extension of the foreign controlled corporation law is this subpart F income. And so it's really defining, this is the type of income that we want to deem as being paid as dividends to us, even that is US parent company, even though you say that the foreign company is not declaring a dividend. The insurance of US risks, income from countries engaged in international boycotts, certain illegal payments, foreign-based company income. Now, the amount of subpart F income that is taxable is less than 5%. If this part constitute less than 5% of total income, then there's no taxable payable. Okay, in other words, there's no dividend paid, no notional dividend is deemed to be paid. But if this income makes up 5% or 70% of the total income, then a portion of the subpart income to the total is taxable. That is, a portion of the subpart income is deemed to have been declared as a dividend to your home parent company in the US. Finally, if these types of incomes make up over 70% of the total income, then 100% of the foreign controlled company's income is taxed currently, as if the 100% of that income was declared as dividend and paid to you, the domestic parent company in the US. So a little bit complicated, but just keep it in mind, even though you control that foreign company and you decide, no, we're not going to pay a dividend because we'll be taxed on that dividend. Okay, this CFC law and subpart F, if that comes into being in terms of deeming the income to be a dividend, then it is a dividend even if you don't pay a dividend. Wow, you need to watch out for this. This is very important. And so we can have an example of several countries where Costa Rica, and the tax rate is 30%, so it's pretty close to the US tax rate, just under that 90% rule. Zambia, 35%, so it's pretty okay. Singapore, 17%, Cayman Islands, 0%. So these two, Singapore and Cayman Islands, will be treated like a tax haven, and so very much likely that this will be deemed as CFC income, subpart F income. But if you're a subsidiary in Costa Rica or Zambia, then it's very easy to argue that the income earned by these subsidiaries is not deemed to be subpart F income under the CFC law, and so therefore you can avoid the complications of the CFC in countries A and B. But C and D, you're going to be under further investigation, and you may have to deem your income to be a dividend paid under the subpart F income and the CFC law. So keep that in mind. These are some of the considerations that the law is impacting on how multinationals develop their tax planning strategy around the world. And so we can have these calculations of the subpart F income. Costa Rica and Zambia are okay because they're not a tax haven, but Singapore and Cayman Islands deemed to be a tax haven. only for the point of view that their taxes are relatively very, very low. It's not because they're good or bad people, it's just that a tax rate is low. Okay, so without getting into the detail of the calculations here, I think the main point we want to take away is that part of avoiding Section F is where you locate your subsidiary. Number 2, the type of income that subsidiary is earning. Okay, and number 3, what is the structure of the holding of that subsidiary? Maybe you can keep it below 50% to still exercise some control over it. Keep those issues in mind. So, a summary of foreign source income taxation. There are factors to be considered. All right, the legal form of the foreign operation. Is it a subsidiary? Is it a branch? The operation, whether the operation qualifies as a foreign controlled corporation. Normally, if it's manufacturing, that's less likely to be qualified as a foreign controlled corporation. It doesn't look like that you have set it up to deliberately avoid tax, to deliberately funnel income away from your parent company's operations in the US. If it's involved in manufacturing, it's likely you are there to take advantage of labor, to take advantage of other economically legitimate opportunities. The location of being in a tax haven, as we saw in that example in Singapore, Costa Rica, tax haven, that will ring some alarm bells. Keep that in mind. Whether the income qualifies as subpart F income, so it's associated with coming from countries involved in international boycotts, illegal income, and other type of income. So these are things that will raise flags as to whether your company, your subsidiary overseas, will be deemed to be paying a dividend even when it doesn't. And as much as I want to go into detail on this without getting into more detail at this part. So the translation of foreign branch income. I'm not going to go into too much detail here, but just to reiterate what we covered in previous weeks, as we want to translate foreign account statements into the domestic foreign currency in order to report GAAP income in the US stock market, we need to do the same if we have to pay tax on foreign earned dividends or foreign earned income of a branch or losses of a branch. We still have to translate from a foreign exchange rate into the US currency. And so that's what this is about, translation of the foreign branch income. It's going to be translated into the US dollars. There's a use of average exchange rate of the year, and it's the net income after foreign taxes are paid. What is added is taxes paid to the foreign government, the payment date, exchange rate, any grossing up. Earnings are repatriated to the US. They're converted to US dollars, difference due to the exchange rate. So there are some things we need to understand here. There is the average exchange rate of the year as being an important part. When you pay a tax to a foreign government, the amount of that tax that you want to deem as a tax credit must be adjusted for the exchange rate at the date of the payment, and any difference due to exchange rate changes, like a foreign exchange gain or loss, needs to be accounted for. So keep that in mind. I think there's 3 things here that we want to pay attention to without getting into the actual mechanics, but these are the things that you need to be aware of when trying to account for the translation of foreign branch income. What about foreign subsidiary income? Now remember, foreign subsidiary income happens when the subsidiary pays interest, pays royalties, or pays dividends to the parent company. Here it's focusing on the dividends paid to the US parent. It's translated at spot rate, that is the date of the payment of the dividend. That makes sense, you pay on one particular date. What is added are taxes deemed paid on the dividend, or if you pay a tax on the dividend, then the payment date of that tax is the spot rate on the date the tax is paid. And then the translated deemed tax paid determined the foreign tax credit. So here we've got two foreign exchange rates that we're looking at, the spot rate on the date of the payment of the dividend and the spot rate on the date of the payment of the taxation in the foreign country. So again, without getting into too much of the mechanics, again, we need to understand the exchange rates and keep good records of the exchange rates on the date particular payments are made. What about tax incentives? This is we're finishing up in this part 2 now by just considering incentives given by various governments around the world, and they're normally associated with encouraging foreign investment. And they're notionally called tax holidays. If you come and invest with our country, maybe it's Indonesia, maybe it's China, you put in so much money, we will give you a tax holiday for 3 years or 5 years or 10 years. And it's an incentive used by governments to encourage foreign direct investment. And it partly and completely exempts the taxpayer for a period of time, and it's offered by many Asian countries, and it's offered by many Asian countries today. Again, this is another part of a multinational tax strategy they need to consider in their tax planning. What's also important is that multinationals can enjoy significant tax reductions if profits are not repatriated, that is, not repatriated back to the USA or back to Germany or UK or France, where the head office of the multinational is. So there's always clauses associated with tax holidays. Yes, you invest with us, okay, we won't tax you, but there are limits on what you can do with the earnings that you make from that investment. So keep these details in mind. These are the questions you need to ask when researching what is the nature of tax holiday provided by the different countries that you may be choosing to invest in. There is also US export incentives. And this is to encourage companies to grow domestically and to export globally, yes, and not just outsource everything offshore. And again, there's the prevention of tax avoidance in this case. So there's clauses in the foreign controlled entity in the subpart F income. There's the Domestic International Sales Corporation, which was a short-lived export incentive program for US companies, but it was repealed due to foreign opposition. And now we have the Foreign Sales Corporation. That's another thing to look out for. It's a short-lived export incentive program for US companies, but was replaced by the Extraterritorial Income Exclusion Act and repealed due to foreign opposition. So there's a lot of incentives the US have tried to give to their own companies in expanding around the world. And I guess the top one, that is the CFC and the subpart F income, is the big elephant in the room at the moment, because this is a thing that's going to affect multinationals, subsidiaries, tax planning strategy. Because if they're in, like I said earlier, if they're in a low tax haven country, they're earning certain non-manufacturing income, they control the subsidiary, then dividends, one portion or if not all, are going to be deemed to have been paid. So keep these things in mind, as I mentioned earlier. American Jobs Creation Act, we won't just skip over that. There was a lot of other incentives that were given. That was back in 2004. That was 10 years ago, so we want to skip over that. So that brings us back to the end of part 2. And in part 2, we actually looked at a bit more of the US-centric approach to taxation and how it's controlling multinationals' branch operations around the world through tax credits, through deductions, and also how it's controlling multinational subsidiaries around the world through the subpart F and the Foreign Controlled Corporations Act. So there is a lot of these extra regulations that multinationals, particularly if you are a US-owned multinational located in the US, have to consider in the tax planning strategy. And so we briefly went through all of these issues for the correct questions to ask or the information to research for when you have different countries that you're deciding where you're going to locate. So let's take it from there. We'll get into a bit more detail when we're talking about how does the tax planning affect in the Asia region. So far the chapter has actually focused on the US centric approach to tax planning, but if we're in Asia, if we're born and bred in Asia, then we've got different incentives and we're subject to different treaties, different laws and so forth. So we need to go into a bit more detail in future videos. Thank you and catch you in the classroom. Bye for now.